All right, so we're talking about price delivery now. So, price delivery is the movement of price from a point A to a designated point B. It's the movement of price by buying pressure or selling pressure from a point A to a designated point B. So it creates candlestick formations that enable us to forecast price next train of actions and creating new support and resistance zones with weak tips and uh, candlestick bodies, because we will need to clarify that too. Candlestick bodies are also support and resistance zones on lower time frame. So on the 4 hour time frame, the candlestick represents support and resistance zones on the lower time frames. So for example, let me draw it out now. So a bullish candlestick on the higher time frame, on the 4 hour time frame. So this is a bullish candlestick. On the higher time frame, on the 4 hour time frame, it represents an engulfing candle. On the 1 hour time frame, so when we mark this out, when we mark the top of the candle, the bottom of the candle, by the time it comes out on the 1 hour time frame, we'll see price action moving like this to the upside. So this is the price action for this same bullish candle that we can see here. So it's um, the support and resistance zones are, it's fractal, so it comes in fractions. So when we see the engulfing candle on the 4 hour time frame, it comes out as support and resistance zones on the lower time frame. Even the wicks also represent support and resistance zones. The top and the bottom of the wicks are support and resistance zones as well. So as we move through time frames, we're able to get this different price action. So let's move back to the charts. So the support and resistance zones act as seats and ceilings for the candles. So as price moves through different price ranges, we see different support and resistance zones that we use to determine our entries in the trade. So with retail trading strategies that depend on lower highs, higher lows, double tops, head and shoulders patterns, and only depend on that for their entries. They are usually being stopped out by liquidity grabs. So liquidity grabs help us to identify the true price points to execute from, and help us to recognize candlestick formations from different price points, making use of volume and pressure within time to help us determine price next move. So we say power goes to the premise with greater pressure. So what this means is price goes to where there is liquidity. Price goes to grab liquidity that can push it further to the next price point. So that is why sometimes on different support and resistance zones, we'll see that the market is not the market doesn't tap into those support zones and react to them. It's as a result of the fact that there's not enough liquidity to push price to the next price point where it needs to go to, and so it breaks beyond that zone, that support or resistance zone, and taps into the zone where there's enough liquidity to push price further. So that's what it means by power goes to the premise with greater pressure. So for example, uh yeah, we're looking at the charts now. This chart's Usdcad. Let's move to the daily time frame. So on the daily time frame, what we can see is sales. The overall trend of the market is sell, right? So we can see it right now. So let's take this note. When price buys in a dominantly selling market and navigates towards a higher buy order, which it intends to push price further, we can see these indecision candles the doji candles. So we'll see that on the lower time frame. Let's look at the overall trend of the market. So the overall trend of the market is a sell. On the daily, we can see a downtrending market on the daily. On the 4 hour, we see the same thing. We can see sales on the 4 hour. Price is in a downtrend. On the 1 hour charts. On the 1 hour chart, we can see the market rallying to the upside. So take this out. You can see high, you can see lows, a higher low, higher highs, higher lows, higher high, higher low. So the market rallies to the upside and taps into a point of interest from the 4 hour time frame, which we marked out. So we can see now that the market has tapped into the 4 hour time frame point of interest where the market was rallying to the upside. Like we said before, when we see that this from this support zone, this demand zone, price was dominantly buying, right? Before it broke all the way to the downside and created an imbalance. So price rallies all the way to the downside to get liquidity. And this liquidity that has been tapped in is what now brings price back to our point of interest. And the point of interest being tapped now, we're looking to see price go lower to the downside. So for clearer entries, we move to the 1 hour time frame. So here we are on the 1 hour time frame. Price is rallying to the upside and then breaks structure, breaks the previous low and breaks the low before it and creates a bullish candle and then continues to the downside. So now we can see that two lows have been broken and price has retreated to the downside after having tapped into the point of interest from the higher time frame. So the next candle will determine whether we're going to take an entry or if price is an entry to the sell side or if price is going to continue bullish. This is the 1 hour. Move to the 30 minutes. So this 30 minutes candle, this spin bar is what gives us a valid entry to the trade. So what this spin bar stands for, this spin bar is the pin bar is a pattern that shows change of trend. So in this case, because of the pressure, the buying pressure, the demand pressure from this zone, as a result of the fact that the market was rallying to the upside before tapping into the point of interest, that's continued the sell pressure from the support from the supply zone. This pin bar is valid. Now let's move to the let's look at it on the web and see what it stands for. So on the higher time frame, the pin bar represents, so I'll need to share that on the screen. So on the higher time frame, the pin bar represents this. What we are seeing right now is what the pin bar represents, right? So what we see on the lower time frame is a candle that pushed bullish before moving bearish, with the bearish candle having a bigger size, is bigger than the previous bullish candle, right? So it forms this pin bar right here, which means that there is a demand a demand, but the demand is being dominated by the supply zone, by the sell orders. So price is tapping in to catch liquidity from the stops of the demand, right? To even seek more liquidity to the downside. So that is what we have on our chart. So we're moving back to the chart now. So this is exactly what we just saw now. Let's move to the 15-minute, but let me mark it out. Let me eclipse it so that we can be clearer on it when we actually see it on the lower time frame. So we have that now. So on the 15-minute time frame, you can see it. The uh, initial bullish candle, the initial bullish candle, and then the dominant bearish candle, just exactly how we saw it on the web now. So what we are looking to see is selling pressure, sending price to the downside. So our take profits will be the next area where the market is going to tap into liquidity. So moving to the higher time frame for clarity, we can see that the wicks, this wicks shows pressure to tap into liquidity and seeking more data to push price to the opposite direction. So the market now tapping into that liquidity pushed price all the way to the point of interest where the supply zone was activated, where the supply was activated. And now that is our next target, because this week tapped into this engulfing candle, which is a strong demand, a strong demand that broke this resistance here. So that's our next take profit, because price tapping into this demand zone will react to the upside or react and move between the range of the last high and the last low to continue to the downside. So here we have our entry. Go to the 30 minutes. Just above our stops will be just above the wick to the upside and just below the wick to the downside. Move to the 15 minutes for a better stop. Okay, yes. Oh, the price taps into our take profits. So it's basically just the price delivery. If you read about IPDA, interbank price delivery algorithm, so there's an algorithm that pushes price to different price points where there are bids and asks for different prices in the market. So that determines the movement of price in the market. So there's an algorithm that moves price. So buying and selling pressure is being determined by this algorithm. Being able to identify liquidity zones within this price movement is how we can find our entries to set stops and take profits that would create a profitable trade and profitable trades in the long run. So this is our trade on USDcad, and I've used this to explain the concept of price delivery, and I'll explain it better on another trade. But this right here is very clear.